Hello and welcome to my channel. In this video, we will be covering chapter number 9, Insurance Planning. This video is part of NISM Investment Advisor playlist. So I recommend you to please go through the playlist. Already many videos has been uploaded. You can find the link to the playlist in the description box at the end of this video as well as on the I button. So now let's start with this one.
Before starting to understand the principles and types of insurance, we must be aware about some of the basic terminologies which is related to insurance. So what exactly insurance is? It is method of transferring the risk of financial losses from one entity to another in exchange of premium. So whenever as an individual you are taking insurance from the insurance company, you would be paying some amount of premium to the insurance company. Now, this premium is the charge which the insurance company is charging you because they would be providing you the coverage for any kind of uncertain loss that could happen in the future. So, for example, if you have taken car insurance and if any damage happens to your car as per the terms and conditions of the policy, the insurance company would be providing you the coverage amount to cover the loss that has been the loss or damage that has been to your car value. Whereas in exchange you would be paying the premium for a certain period of time to get that coverage. Now, who is an insurer? So the company selling the insurance is referred as insurer. Insured, the person or entity whose risk is covered through insurance is referred as insured. So when you are taking insurance from insurance company, you are the insured and the insurance company is insurer. What is premium? We already talked about it. It is the charge for a certain amount of coverage which you are taking. Policy, it is written contract or certificate of insurance. So whenever you are provided with insurance policy which mentions the terms and conditions, it is forming a kind of contract between you and the insurance company. So it is a certificate of insurance which is a proof of all the terms and conditions related which would be fulfilled to the contract to be legal. In case those terms and conditions are not fulfilled, those contract can also be considered as void or illegal. Risk, uncertainty of future or deviation from expected outcome resulting into losses. So why is anyone taking insurance? The basic factor is the risk. So risk is referring to uncertainty of future. Whenever you are purchasing your own house, now you are not sure that your house would be remaining in the same condition. In any case, if any natural calamity occurs and there is a lot of damage to your new built house, the property, so there is a kind of risk related. Now you are taking the coverage, the house insurance, the home insurance to safeguard that risk. In case of any damage or property loss, the coverage amount which would be provided to you would not depend on the premium which you have provided. So the premium is very low. However, the coverage amount would be to serve your damaged amount. So if the damaged losses is very high, the coverage would be provided. The coverage amount would also be high. Irrespective of how much premium you have paid till then. Now, what is peril? Peril is cause of a risk and losses. So, for example, natural disaster. Now, natural disaster is a cause of a risk because when it comes any kind of floods or cyclones, there is a lot of damage to the property as well as the human life. So, that is a cause of risk. So, any cause of a risk would be referred as peril. Now, hazard. Hazard is condition that increases the frequency or severity of loss. Cause of risk was referred as peril. However, whatever increases the severity of loss, that would be referred as hazard. So, for examples, when the natural disaster came, that was peril. But however, the open electric wires, which could increase the severity of loss, which could increase the damages, that would be referred as hazard. Now let's move on to what are the requirements for insurable risk. So not all kind of risk could be insured. What risk has to be insured? So it should be pure risk. Now pure risk means that there should be chances of loss or no loss. There should be no scope for profit. So insurance companies would be covering your loss amount and would not be providing you any kind of profit. Second is accidental and unintentional. So to get an insurance, it's very important that the risk or the loss should be or the loss in any scenario should be accidental and unintentional. So it can't happen that intentionally you are damaging your vehicle and you are claiming the insurance amount for your vehicle insurance. So the requirement is that it should be unintentional and it should be accidental. So the risk and the loss amount should not be specified, should not be certain, it need to be uncertain. Feasible premium. Insurance companies come up with the policies, only those policies where they could provide feasible premium. So that makes it very important that the need for that particular insurance, for example fire insurance, home insurance, the life insurance, these are the insurance for which the need of for which there is need of large customers, large set of people having the same need, having the same risk of losses, which is there in their day to day life. And for this reason the insurance company could provide feasible premium, which is a very low amount as compared to the coverage amount which the insurance companies provides in case of any loss. Thus, to make the premium feasible, it becomes important that the need should serve large set of customers. Large number of exposure units. So this already I have mentioned that to any insurance policy to come in the market, it's very important that there is need of large number of people, or else that insurance would lie insignificant and the insurance companies could earn nothing by it. So it's very necessary that there is a need of that particular insurance by a large set of people. Now it should be measurable. So measurable defines here the loss amount that has to be measured by the insurance company before providing you any coverage. So for example, you have taken insurance, your home insurance, and any damages happen to your property. Now it's not that you would be claiming any unspecified, any sort of amount and the insurance company would be paying you that. It's that the insurance company would come, they would the insurer, the agents would come, they would investigate your property, and they would try to analyze how much should be the loss amount and what coverage should be provided accordingly. So it's not that whatever you ask for would be provided by you, it would be provided to you. It is on the basis of the measured loss amount, the coverage amount which would be provided. No high probability of loss. So it's also very important because the whole insurance business runs on probability of loss. So if there would be high probability of loss, the insurance companies would be running in losses itself, because the chances of them paying the coverage amount and you getting secured would be higher. So here the chances should not be significant. So they won't be providing you insurance if there would be high probability of loss. So for example, if you are going through a critical illness, you are going through cancer and you are asking for health insurance, they may not be providing you the insurance, the health insurance, because they know that the chances of you dying is very high, and thus if they would be providing the coverage amount they would be providing for it would be very high in compared to the premium which you have to pay. So the chances of loss should not be very certain, should not be very high. Insurance as subject matter of solicitation. Now this line forms the basics of insurance, which says that the insurance has to be asked or requested, and it is not meant to be sold as any financial product. So the customer should ask for insurance because it is their need to cover their risk in day-to-day life, and the insurance agents would be guiding by suggesting them the insurance policy as per their need. But it is not something to be sold in the market, it is to be asked by the customers. Now coming to types of insurance. So insurance is basically, we can divide it as life insurance and non-life insurance, which is also referred as general insurance. So in this general insurance module, we would be covering various topics like fire insurance, health insurance, motor insurance, and marine insurance. Life insurance can be defined as a contract between the insurance company and the policyholder So yeah, exactly, it is a contract because the insurance company is binded by the law to pay you under the terms and policies covered in case any uncertain event occurs where you lose your life, or you are dead, or on upon the benefit or upon the maturity the benefit has to be provided. So here the insurer provides coverage, that is the sum of money to the insured. Insured means the policy holder. Insurer is the insurance company who would be providing the coverage, and in exchange for a premium. So you would be paying the premium as a policy holder, as the insured, you would be paying the premium after a set maturity period or upon the death. So yeah, according to the terms and conditions of the policy, the insurance company will be obliged to pay you the coverage amount, that is the sum of money, upon the maturity period or upon your death, as per the terms and conditions of life insurance policy which you will be taking. Now we would be looking after various life insurance policies. The first will be term plan, then endowment plan, money back plan, ULIP, and pension plan. So one by one we would be learning about each of these and try to understand the basic difference, and so that you can match your requirements with the kind of policy you want for your life coverage. So first is term plan. Now, term insurance is a pure risk cover product. It pays a benefit only if the policyholder dies during the period for which one is insured. So it is a pure risk or pure insurance product, because insurance product is not meant to provide you any benefit. It is meant to cover you against any kind of risk or loss. So term insurance serves that basic purpose. If you die, it would be providing you the benefit. If not, you won't be provided with any kind of benefit. This is the basis of term plan, which is a pure insurance product. It will provide you benefit only if you die, because it is a life insurance product. And if you are not, and if you didn't die, you won't be provided with any benefit even after the maturity. So term life insurance provide life insurance coverage for a specified term of years for a specified premium. So this is called as term life plan, because it is for a specified period of time. For example, from 5 years to 30 years, it can be ranged depending upon the policy you are taking, the insurance company which is providing you. So it depends on the number of years for which you are taking the term plan. And you would be paying specified premium, which is a very small amount. So in term plan you can get about an estimated 1 crore of coverage amount only by about 500 rupees of premium per year. So this is the small amount of premium which you are paying to get a huge coverage amount. So it would be beneficial if you to cover any kind of uncertainty related to your life risk. Term insurance premiums are generally low because it only covers the risk of death and provides no return. So as I said, for example, term plan you have taken was for 10 years. In that 10 years of time, you did not die. So you won't be provided with any kind of benefit, any kind of coverage. You won't be returned with your premium which you have already paid. But if you die in between that period, you would be provided the whole coverage amount, which would be a very huge amount as compared to the premiums you have paid. So it is a pure insurance product to cover the life risk. If policyholder or insured dies before that specified term is over, his beneficiaries receive a payout. And if he survives the term, there is no maturity benefit. So as I already mentioned, only if you die within that term period, you would be provided with the benefit or the coverage amount. But if you have survived, there would be no maturity benefit. Second is endowment plan. Now, endowment insurance policy provides insurance coverage along with saving feature. So here you are, this is a kind of product where you are putting up your money to save also. So it's just not an insurance risk cover, it's providing you a saving option as well. Sum assured and any accrued bonus is paid out at maturity of the plan or if death occurs during the term of policy. So if during the term of policy, your death is occurring, you would be provided, your beneficiary, would be provided with the whole sum assured, and any kind of accrued bonus if the company is if the company has declared it is going to pay out to the policy holders, that would be provided at maturity of the plan, even at the maturity of plan. So for example, you have taken an endowment plan for 10 years. So on maturity after 10 years, you would be provided with the coverage amount whole as well as any accrued bonus. And if you die in between that term period, then also you would be provided the whole coverage amount and the bonus amount. So as we see in the term plan, you were provided with the benefit only if you die. But here, if your death doesn't occur, you are provided with the coverage as well as bonus amount on maturity. So it is an endowment plan, which is also referred as saving plan. But the only thing to keep in mind here is that because it is providing you kind of saving option, also the premium rates will be higher as compared to the term plan. And maybe the coverage will be lower as compared to the term plan, which it was providing at the lower premium. So see, this is our next point. Premiums are generally higher as compared to the term plan since guaranteed sum with assured bonus is provided on maturity. So it makes logic that because you are being provided with guaranteed coverage as well as bonus amount on maturity, you would have to pay premiums which are higher as compared to the term plan. The maturity period of policy may range from 5 to 30 years. Again, as we discussed in term plan also, endowment plan also provides you with variations in the term period which you can choose for. So it ranges between 5 to 30 years. Our next is money back plan. So money back insurance policies are type of insurance policies that provides life coverage and also assures the return of a certain percent of the sum assured as cash payment at regular intervals. So if you are looking for an insurance product which can provide you regular cash inflows also, so that is money back plan. Here you can get assured sum as cash payment at regular period of time. So maybe in 3 months, in 6 months, as per you have chosen the plan, as per the time period you have chosen, you can get the cash payments. Now this is why money back plan is becoming popular in these time, because this policy is not just covering your life, it is also providing you a regular income source. Now, regular payouts made in money back plan are also referred as survival benefits. This is also referred as survival benefits because you are provided with this regular payout and you have survived till this term period. So you have not died, you have survived, and that's why it is called a survival benefit payout. The rate of return on this policy is quite low. Obviously, insurance products are not meant to provide you any investment options, so the rate of return which would be provided in any kind of insurance product would be very minimal, very low. So you must treat that as a risk coverage option, as a saving option, and not as an investment option, as a necessity rather than any wealth creation option. If the insured dies during the term of policy, full sum assured is paid out irrespective of survival benefits already paid. So here what is happening that you are being provided with regular cash flows at regular intervals. Now what happen if you die in between your term period before the maturity? So in that case, you would be provided with the full coverage amount. So you don't have to worry that you have already been provided with regular cash flows. So that amount would be deducted and you would be not provided enough coverage amount on your death to your family members, to your dependents, to your beneficiaries. No, it's not that. Upon your death, you would be provided with the full sum assured according to the policy and irrespective of the survival benefits that has already been paid to you. Accrued bonuses are paid on maturity or death as in the case. So here also if there is any bonus declared by the company as per the policy, so that would be paid on maturity or upon death as in the case related to the policy holder. Let's look after unit linked insurance plan, which is popularly referred as ULIP plan. So ULIP is an insurance plan that combines insurance protection with investment option. Here, this product was introduced to combine the future of both insurance as well as investment option. So many people who are afraid of investing in stock markets and all, this product came to be useful because it was providing you with an investment option along with your insurance and building up the trust. So it enables the policyholder to earn market-linked returns by investing a portion of the premium money in various proportion in the equity and debt markets. So here the premiums which you are paying because you have taken this ULIP policy, those premium, the some amount of that premium would be invested in the equity and debt market. Now, according to the market fluctuation, according to the performance of the market, the return would be dependent. The return from your insurance policy would be dependent because that would be linked to the market. Some proportion of your money would be invested in that. So it is providing you coverage by keeping aside your proportion of money and investing some of the proportion of money in the market. So it is providing you with the both option, the insurance coverage as well as the investment option. The ULIP provides both death and maturity benefits to the holder. At the time of maturity of the plan, the policy holder will receive the value of the fund as on the date. Since ULIPs are linked to the market, the proportion is invested in the market. The value which the policy holder will be receiving would be the fund value as on the date, and the fund value will keep on fluctuating. So generally ULIPs provide good returns as compared to other insurance products because other insurance products are made to provide you coverage amount, a saving option, but wasn't designed to provide you any investment return. So here ULIP provide you a good return about 10 to 12% depending on the market condition. And the only demerit is that people does not accept ULIPs because it is not pure insurance. So the coverage amount would be very less. The coverage which should be provided to cover the risk would be very less. However, the return would provided to you would be good, and it would be serving as an investment option. In the event the policyholder dies during the term of policy, the beneficiary will receive either the sum assured or the fund value or both depending on the terms of policy. So this would depend on the term and condition of the policy, what you will be receiving. So before you are going to take any ULIP plan, you need to discuss all these things. You need to go through the terms and conditions to understand what returns you can get and how this would help in your risk coverage, how this will help in getting the returns if you want any. Now, basically, it is recommended that you should not purchase any insurance plan as an investment option because insurance is majorly to cover the risk in case of any uncertain event. So if you are taking life insurance, you should look for high coverage amount which would be good enough to serve your family, to serve your dependents with low premium, and you should not go for return etc. So whenever you are taking any insurance policy, just see that if you are getting good coverage to serve your family, if you have to pay lower premiums, all these options are good, and you should not focus on getting returns. Whereas it's your choice, you can always compare and choose as per your preference any of these plans. The introduction. Before going on to motor vehicle insurance, let me give you a brief about general insurance. So all that is non-life is referred as general insurance, which comprises of motor insurance, fire insurance, then marine insurance, etc. So this was a brief about general insurance to give you an idea, and thus motor insurance is a part of general insurance module. So let's start with the introduction of it. Motor vehicle insurance is the insurance coverage of risk arising out of the use of motor vehicles such as car, truck or other vehicles causing damage and loss to oneself as well as others' property in an accident. So motor insurance is also motor insurance you could refer whenever you are taking insurance for the coverage of risk that could arise in form of damage or loss to your own vehicle, or maybe you are causing damage to someone else's vehicle in sort of any accident on road. Thus it becomes mandatory to get a motor vehicle insurance which will insure your car as well as your life in case of any accident, any injury caused. Let's see. Motor insurance is mandatory as per the Motor Vehicles Act passed in the year 1938 and subsequently amended. So this has been mandatory because whenever you are driving on road, it's not usually that in an accident only your car will be damaged or only injury to yourself would be happening. In any sort of accident, you may be damaging someone else's property and someone else's life, and thus it has been mandatory to take motor vehicle insurance. And this comes under Motor Vehicles Act that was passed in 1938, and this act has been subsequently amended many times. Now in recently there was an amendment made because of which the compensation on various traffic rules violation was increased. Motor insurance provides coverage related to property damage, bodily injury, medical expenses, and any other sort of compensation in legal proceedings. So, what all things it provides coverage for? It provides coverage for property damage. So, either your vehicle has been damaged or any property related to it, your bodily injury, any kind of injury you met in an accident, then the medical expenses which you have to incur because of those injury which happened throughout the accident on the road with another vehicle, or maybe any sort of compensation. So many a time it happens that in an accident maybe the other party would be suing on you because of your mistake of violating traffic rules. So in that scenario you may end up paying a large amount of compensation demanded by the other party. So insurance also provides you coverage for those compensation which is involved in any sort of legal proceedings arising due to accident on road by third party. Now, motor vehicle insurance, you can also refer it as auto insurance, vehicle insurance, or car insurance. Now, let's see what are the types of motor insurance. So, first one is private car insurance. Whenever you are taking insurance for your own vehicle, which you have to run for your private uses and no commercial uses, so that would be referred as private car insurance. Second is commercial vehicle insurance. So insurance which you are taking for the vehicle which is going to be used for commercial purposes, which would be involved in any sort of business, delivery business, transportation business, etc. So commercial vehicle insurance. Then defense vehicle insurance. So the insurance for the vehicles which are involved in defense, like the heavy vehicles which are there in the defense segment, so taking insurance for those vehicles. And then there is two-wheeler insurance for your two-wheeler vehicles which you own, so the insurance for that would be referred as two-wheeler insurance. And here you can signify that you have to, when you are taking insurance, you have to mention the type of vehicle you own as well as the use of that vehicle. So it's very much in the policy that you have to mention the use of that vehicle, whether you will be using it for your private purpose or for business purpose, or will it be involved in any sort of defense activity. So all those things you have to mention while taking insurance policy, because that is what that would be combining the premium amount which you would be paying for your insurance policy. Now let's see what is third party liability. So we already referred as third party liability. Let's understand it. So motor vehicle insurance generally comprises of following two components. First one is third party liability, which is mandatory, and second one is owner's damage, which is optional. So motor insurance, when we say that it is compulsory or mandatory, that is because of third party liability. So third party liability is when you met an accident and you are causing damage to another person's property or another person's life or any injury. So it becomes important that you take insurance which would be providing coverage to help out that person to recover from that injuries or properties damage. So third party liability is thus mandatory. Whenever you are driving on the road, you are getting the vehicle, the driving license for your vehicle, you must have to take the third party liability, which would be comprised in the insurance policy, the motor insurance policy which you would be taking. And then the owner's damage is optional. So the damage which would be happening to your own vehicle, so that is optional. You may take or you may not opt out for it. Let's see. Third-party liability coverage is the part of insurance policy which protects you in case you are sued or asked compensation for any physical injury or damage to someone else's property by your vehicle accidentally. So, any sort of accident in which you are causing damage to some other person without the other person's fault, it becomes necessary that your insurance policy protects you to pay compensation to that person to recover from that injury or that property damage. Third party liability could be of following nature, so it may be bodily injury caused to the third party, that is the another person, or it may be the property damage. So any sort of property damage which you are causing to their vehicle or their property, so that would also be covered under this.
Insurance policy that provides coverage to the policyholder and family members against the medical cost. Now we know that healthcare treatments are getting expensive these days, and in case if there is any health issues or any critical illness or any kind of disease, the treatments can be very expensive and it can hamper the financial position of the family. So it becomes important to have a health insurance that can provide a good coverage to the policyholder as well as the family members. Now let's have a look at some of the types of health insurance. So first is critical illness plan. This plan is usually taken for the critical diseases like the heart attacks, the organ transplants, kidney failures. All those diseases are covered under critical illness plan. Then there is individual health insurance, which covers an individual policy holder, different from family floater plan, because family floater plan will be covering your family members as well. So it maximum, I guess, it covers 3 to 4 family members along with you. Your parents can get covered, and so will be the premium decided. Senior citizen health plan, again, which a health plan which can be availed by senior citizen. The premium would be on higher side because as early in your life cycle stage you take the insurance, you take the health insurance, lower will be the premium amount because there would be a larger tenure to be covered. And if you are taking the health insurance at a stage where you are a senior citizen or somewhere before that, so it would be more costlier because you have to pay a huge premium amount for that. Then there is unit linked health plan, which is now like a combination of health insurance as well as investment. So whatever money you are paying as premium, a portion of that money will be going in investment, going as a form of investment, and another portion of the money will be used to provide coverage as an insurance. So it is unit linked health plan is a combination of investment as well as insurance. Coming to some of the tips to buy best health insurance policy. So you always have to look out for a maximum coverage amount so that the expensive medical cost can be covered at the time of requirement and you don't have to put money by your side as well. You have to look out for cashless treatments because the money would directly be paid to the hospitals, and thus there won't be any burden or hassle situation that you need to take the cash and then you need to make the payment. So go opt for cashless treatments. Whatever health insurance policy is providing cashless treatments, you consider that. Large network of tie-ups with hospitals. So you also have to look out if you're opting for health insurance policy that the policy has a good tie-up with different hospitals, especially in your area, because in the situation of emergency, you can be admitted over there or any of your family member and you can avail the benefit of the insurance coverage. You have to look out for additional benefits like the ambulance being provided, the restroom, and etc. Additional cost that is incurred. Compare different policies. It's again very necessary that you compare different policies. There are n number of policies today available in the market. So you have to choose and opt for the suitable one by considering all the criteria involved. Take advices if necessary. Look out for claim settlement ratios. So claim settlement ratio will be giving you an idea that for this policy, how many people have made a claim and out of those claims, how many have been settled. So in future, if you are going to claim for the insurance coverage, are you sure that The company will be settling your claimed amount. So claim settlement ratio will give you an idea about it.
IRDAI stands for Insurance Regulatory and Development Authority of India. So, from the name only, you can get an idea that it is a regulatory authority governing insurance sector. So, the full form is Insurance Regulatory and Development Authority of India. IRDAI is the regulatory authority entrusted to govern the insurance sector of India. It provides license and defines capital as well as net worth requirement for formation of insurance companies. So any insurance company which is going to be formed, they need to take license and approval from IRDAI mentioning their capital as well as net worth requirement. There is a specified capital which you should have, specified net worth which you should have if you are going to form any insurance company. Then after you can get license from IRDAI. It defines rules and regulations and lays down terms and conditions to be followed for existence of insurance contract in terms of claim settlement, coverage, products, nominations, insurable interest, etc. So all the matters related to insurance contract related to the insurer as well as the insured, or we can say the insurance company or the policy holder in between. Everything related to the claim settlement, the coverage amount that is to be provided, the terms and conditions, the nominees which are there, which insurance products can be sold in the market, to whom those products could be sold, who are eligible, under what conditions, what regulatory norms are to be followed. All these things are defined by IRDAI, and all insurance companies have to follow the terms and conditions, the rules and regulation laid down if they want to run the insurance business. It lays down the qualification and training requirements of insurance agents and the payment of commission to the distributors. So along with the rules and regulation, it also lays down what qualifications are needed, what trainings should be provided to the insurance agents so that they can distribute the insurance policies to the policy holders, to the customers, and they can make them understand in a good manner the importance of the insurance to be taken as necessity to serve their life, and the payment of commission to the distributors. So the insurance policies are distributed by the banks, by the private companies as well as the agents and all. So what commissions to be paid to those distributor, what should be the premium, what should be the commission provided to them, all those are mentioned under IRDAI, and it keeps on changing as per the norms and procedures of IRDAI. So basically IRDAI is there to govern, to look after the insurance sector so that no policy holder is misleaded and the insurance products are sold to serve the basic purpose of insurance needs and to cover the risk.
Let's move on to the chapter end questions. Try attempting these questions. Which of the following products is a pure insurance product? Option A, ULIP. Option B, money back policy. Option C, term insurance policy. Option D, whole life policy. Choose the correct option. And the correct option is option C, term insurance policy. Question 2. In which of the following situations will the insured not have the insurance cover? Option A, surrendered policy. Option B, paid up policy. Option C, term policy. Option D, both A and B. Choose the correct option. And the right answer is option A, surrendered policy. Question 3. The premium payable on a ULIP is higher for the same sum assured as a term policy because the period of cover is shorter, a portion of the premium is used for investment, the pool of insured is smaller, the risk is higher. Choose the correct option. And the right answer is option B, a portion of the premium is used for investment. Coming to question 4, the term of insurance in non-life insurance is typically option A, decided by the insured. Option B, decided based on sum insured. Option C, 1 year. Option D, flexible. Choose the correct option. And the right answer is option C, 1 year. Thank you for watching. Please show some support. Do like the video if you really like it. And as an appreciation, subscribe to my channel. It would be really helpful. Make comment, provide advices. If you have any query, let me know in the comment section. I'll be happy to help you. Thank you for watching. Thank you so much.